Hello everyone and welcome again to Nettle, the best platform around for distance learning in business, finance, economics and much more. My name is Sava and today we're starting a whole new mini-series of tutorials on stock market anomalies, that is, weird patterns of stock market returns that seemingly cannot be explained within the framework of conventional finance models. The topic is pretty exciting and pretty diverse, and it's at least 5 decades old now. It all started pretty much in the 1960s when the first stock market anomalies have been discovered. And those were calendar anomalies. That is, when the stock market behaved seemingly weird on various days of the week, on various days of the month, or in various months of the year, and so on and so forth. So the first of those effects has been the so-called weekend effect, that has been identified in 1962. Sometimes the weekend effect is also talked about separately in terms of Monday effect and Friday effect. And the behavior of the stock market in Monday and Friday is considered to be generally the behavior of the stock market around the weekend. So what it's about? It has been documented that at least in the 1960s, the stock market has been drastically underperforming on Mondays, showing much lower and sometimes even consistently negative returns on Mondays. While on Fridays, the situation has been the reverse. The average returns have been much higher than the weekly average. And there has been multiple explanations provided for that, from simple human pessimism that investors are not the exception to, that everybody hates Mondays, and at the start of the new working week, everybody is more prone to panic or thinking that life is worse than it actually is, and so on and so forth, to more sophisticated theories such as investment funds trying to exaggerate their weekly performance indicators by overbuying various stocks at the end of the reporting weeks, so on Fridays. But we're not concerned with the explanations today. What we're concerned with is whether the calendar anomalies, Monday and Friday effects in particular, or the weekend effect, if we name the two jointly, is still relevant for the US stock market and for the developed stock markets in general in the current day and age. So let's identify whether the stock returns on Mondays and Fridays are any different from stock market returns on other days using 5 years worth of recent data for S&P 500. And today I'll show you how to simply test for the existence or non-existence of Monday, Friday, weekend effect using Excel, and explain some neat statistical tests along the way that can be applied to many other problems in business economics, finance, and much more. So, first of all, to figure out whether the returns on Mondays or Fridays are higher or lower, whatever, we need to figure out which days can we actually label as Mondays or Fridays. And Excel is extremely convenient for this purpose because it has the function that is called weekday. The function weekday can convert any date in any format into a number from 1 to 7 that would represent a particular day of the week. But beware, Excel has a various number of representations for the enumeration of the days of the week. So here we need to select 2 that numbers days from 1 Monday through 7 Sunday. And that's not the default representation of weekdays as numbers, so we have to explicitly state that we want that. So weekday of the date cell, and we specify that the representation is number 2. So we see that the 2nd of January 2015 has been the 5th day of the week, so it has been a Friday. Hooray, we have already identified a Friday. But if we bottom right click it all the way down, we can see that all of the trading days are being labeled as various weekdays, numbered from 1 to 5 naturally, because there is no trading on weekends, on Saturdays or Sundays. So now we can actually figure out which of those are Mondays and which of those are Fridays. So if the number of the day of the week is equal to 1, then we're pretty sure it's Monday. And if it's not equal to 1, then it's definitely not Monday. Alternatively, if the day of the week is equal to 5, then it's surely Friday. And if it's not, then no, it's not a Friday. And now we can bottom right click it all the way down and see that this simple function effectively labels all Mondays and Fridays as 1s and all other weekdays as 0s. Now we can apply a bunch of conditional functions in Excel to figure out average returns and their volatility, to then apply different hypothesis testing tools to figure out whether really the market is underperforming on Mondays and outperforming on Fridays. First of all, let's calculate the average return on Mondays. To do that, let's apply the average if function. First of all, the range should be this array that represents Mondays, and we need to select only Mondays, so we need to select the ones that we have just labeled. And we need to average the returns, that is the S&P 500 returns, this column, according to the classification into Mondays and non-Mondays. And here we can see that the average return on the Monday is indeed negative, and it's minus 0.01%. So there is something true about it, seemingly, but we can't actually say anything definitely without first knowing the average return on other days of the week, and also knowing the variance to apply rigorous hypothesis testing. Now, to calculate the average return on the Friday, we can actually apply a little trick. So we can just copy this formula over here, and given the fact that everything is the same apart from the column over here, we need Fridays instead of Mondays, we can just drag this selected range one column to the right, and we will get the correct formula for the average return on Fridays. So now we can see that the average return on the Friday is 0.03%, so quite a bit higher than the return on Monday, and positive. So again, some reinforcing evidence here. But let's figure out what is the average return on the days of the week that are not Mondays or Fridays. To do that, we need to apply the average ifs function. And here first we need to input the average range, well, that is the range of returns. And then we need to specify that we don't need Mondays. So here we should input 0, so non-Mondays. And we also need them to be non-Fridays, so here it's 0 as well. And we can see that the average return on Tuesdays, Wednesdays, or Thursdays is actually higher than that on a Friday, 0.06%. So here already we can see that the notion that the stock market outperforms on a Friday doesn't actually stand the test against the real-world data. But maybe something is true about the Monday effect. Let's figure it out. To do that, we need to calculate the variance of the stock market returns, again on Mondays, Fridays, and other weekdays. To do that, we need to first of all apply the sample variance function, var.s, but then we need to apply a neat trick that few people know of actually, that will allow us to just select the returns on Mondays, Fridays, or other weekdays. So here, inside of the parentheses that specify the argument of the sample variance function, let's input if. So if the column that specifies Mondays is equal to 1, so on Mondays, we will pick the S&P 500 return, but if it's not a Monday, we'll just select nothing, so empty parentheses. We can avoid specifying the empty parentheses, but here I'll stick with that just for clarity. And now we need to close the parentheses for the if function, close the parentheses for the variance function, and press enter. And we can see that this manipulation with Excel commands has correctly calculated the variance of the stock market on Mondays. For Fridays, we can do exactly the same trick. So copy this formula, paste it over here, and just drag this column to the right, and we get the variance on Fridays. And we can see that those are actually comparable, but the variance on Fridays is slightly higher. And for other weekday variance, we need to be even smarter than we have previously been. Again, we start with sample variance function. Then we specify that our column that identifies Mondays should not identify a Monday because we are concerned with non-Mondays, but we're also concerned with non-Fridays. So we need to apply a nested condition here, a nested if, and select the Friday column and require it to be 0 as well. And if both are satisfied, we can finally select our return array. And then we can close the parentheses again and yet again, and if we press enter now, we can correctly compute the variance on all other weekdays. And we can see that it's quite a bit lower than the variance on Mondays or Fridays. Then we need to calculate the number of observations that correspond to Mondays, Fridays, or other weekdays. Well, we can just apply the count if function, counting the number of ones in this column, and then counting the number of ones in the Friday column. And we can see that across those 5 years, there has been 17 more Fridays than Mondays. Is it a mistake? Well, no, because those are trading Mondays and trading Fridays. And it needn't be the case that there is the same amount of trading Mondays and trading Fridays. Why this discrepancy arises is because there are more public holidays that overextend to the next Monday, and therefore it is more likely that the stock market would be open on a Friday than on a Monday. So just a simple, neat observation regarding market opening times. And now here we can actually be a little bit cleverer still and just subtract those two values from the total number of observations, and we pretty much know it by heart now that 5 years worth of S&P 500 returns is 1,258 trading days. So minus the number of Mondays and minus the number of Fridays gives us 769 Tuesdays, Wednesdays, or Thursdays that have been trading days. Now, having computed the means and variances in these three subcategories of our trading days, we might want to apply the Ttest for the equality of means. But there is a little caveat that we need to account for. Well, there are two different T-tests that one can apply to test for the equality of means. The equal variance T-test, which is the simpler one, and the more complicated one, which is the unequal variance T-test. And when you are approaching a particular problem, you actually don't know in hindsight which of the two tests is the best, because, well, you don't know whether the variances across the groups are equal or not. So first, we want to test whether the return on Mondays is different from the returns on the other weekdays, and likewise whether the returns on Fridays are different from the returns on other days. So we need to figure out whether the variance of the returns on Mondays is different from the variance of the returns on the other days, and in a similar fashion whether the variance of returns on Fridays is different from the variance of returns on Tuesdays, Wednesdays, and Thursdays. To do that, one can apply the Ftest for the equality of variances. First of all, it's really simple. It just divides the larger variance across the two over the lower variance, and it would return a value that is larger than or equal to 1. And then we can assume that this ratio follows an F distribution, so Fisher's distribution, with the number of degrees of freedom that is equal to the number of degrees of freedom we use to calculate the variances, and figure out whether the two variances are significantly different from each other. So first, let's calculate the Fstat for the Multieffect test. That would be just the variance on Mondays divided by the variance on the other days. If I wanted to make this formula even more flexible, I would have applied max and min functions in Excel, but as we already know which variance is higher, we can just simply divide one by the other. And for the Friday effect test, just divide this variance by, again, the variance on all other days. And we get 1.20 and 1.23. Well, is it enough for one variance to be 1.2 or 1 times 3 times the other variance to conclude that the difference between variances is statistically significant? That is, that from a statistical point of view, those two variances cannot be treated as the same. Well, to do that, we need to derive the respective p-values from an F distribution, so Fisher's distribution. So here, let's apply the Ftest, the right-tailed Ftest, because, well, our Fstat can be only 1 or higher, so we're concerned only with one of the tails of the F distribution, as we already know which tail are we falling at. So our Fstat is this, so 1.20. The first number of the degrees of freedom is n-1 for Mondays, and the other is n-1 for other days of the week, because, well, that's exactly the same logic that we use when we calculate sample variance, for example, dividing by n-1 instead of n. And now we can close the brackets and enforce the formula and get 4.11%. It means that the variance on Mondays is significantly higher than the variance on other trading days. Now we can apply the same logic for the Friday effect test. We can just copy this formula, paste it here, and change the respective cells to refer to the Friday related cells, and see that the situation is exactly the same, and the p-value is lower than 5%. That means that those two variances both are significantly higher than the variance on all other days. And that means that we cannot apply the usual simple equal variance t-test, and we need to resort to the unequal variance t-test. Well, first of all, for any t-test, we need to calculate the difference between the means. So the difference between an average return on a Monday and an average return on another day is minus 0.07%, and the difference between an average return on a Friday and an average return on a Tuesday, Wednesday, or Thursday is minus 0.03%. So in both cases the return is lower. Now we need to determine, is this magnitude significant enough to consider it not a random chance, but something persistent and something worth noting. We need to calculate the standard deviations of these differences using the procedure outlined in the unequal variance t-test, that is over here. So the standard deviation for the test would be equal to the square root of the sum of the respective variances inversely weighted by the number of observations. So here we can just apply the square root function and first get the Monday variance divided by the number of Mondays plus the variance on other days divided by the number of other days, close the brackets and enforce the formula, and see that the standard deviation is 0.06. Now we can again just copy this formula, paste it across, and drag those down, and see that those two are very similar, but they are not exactly the same because, well, obviously we input different numbers into this formula. This is just a coincidence because we have just two decimal places. The yet trickier bit is to correctly specify the number of the degrees of freedom that one should use with the unequal variance t-test. I need to concede here that it's not that important when you have a large number of observations, as the degrees of freedom are very relevant for the t-test only when the number of such is small. If you have more than 30 observations or more than 200 observations like we have, the number of degrees of freedom wouldn't change your results much. But just for due diligence, let's figure out the correct procedure that one needs to apply to get a statistically precise result. So the number of the degrees of freedom in an unequal variance t-test is calculated using this formula. The numerator of this ratio seems really familiar. That's just the estimate of a sample standard deviation to the fourth power, basically, because here we take the square root and here we square it. So good enough. And the denominator is basically, again, squared variances, so standard deviations to the fourth power, but they are inversely weighted according to the square of the number of observations times the number of the degrees of freedom in each of those two cases. So without further ado, let's disentangle this formula. So here, for time-saving purposes, we can just raise the already estimated standard deviation to the fourth power, and unfortunately the denominator we would have to input from the scratch. So first, S1 to the fourth power. That's variance on Mondays squared. Then we need to divide that by, open brackets, first, the number of observations squared times the number of the degrees of freedom, so the number of observations minus 1. We close the brackets again. Move on to the next component of this sum in the denominator. The variance on the other days squared, so standard deviation to the fourth power, analogously divided by the number of observations squared times the number of observations minus 1, that is, the degrees of freedom for this particular case. And then we close the brackets for the denominator, and we can calculate the number of the degrees of freedom that way. And we see that the number of the degrees of freedom here is 364. Now again, applying some cheating, we can drag those down for the case of the Friday effect test, enforce the formula, and see that for the Friday effect test, the number of the degrees of freedom would be slightly higher, 396. Now we can finally calculate the Tstats and the respective p-values for those two tests. So the Tstat for the Monday effect would be the difference divided by the standard deviation, that is the same regardless of the type of the t-test you are using. It's just how you arrive at the standard deviation, the degrees of freedom precisely, is what singles some of the alternatives from the others. And we drag it down, and we see that the t-stats are minus 1.01 and minus 0.47. And from the rule of thumb that you might already know, when the absolute value of the t-stat is lower than 2, there is not much of statistical significance to expect here. But to actually state it using rigorous hypothesis testing, we need to calculate p-values precisely. To do that, let's apply the Ttest to t function, which is the two-tailed t-test, using the student's t-distribution. As our x, let's input the absolute value of the respective t-stat. And the number of the degrees of freedom, well, we have gone through all this pain just to calculate those, so just let's refer to this cell. Close the brackets and see that the p-value is 31.46% here, way too high to reject the null, and in the other case way higher at 63.9%. What do the results tell us regarding the Monday and Friday effects on the US stock market? Well, they tell us that during the most recent 5 years, they have been virtually non-existent, statistically undistinguishable from zero. Does it mean that they have never existed? Of course not. They are pretty well documented in the 60s and even in the 70s and 80s. So what happened? Well, they have just disappeared with time as the market has grown knowledgeable regarding the stock market anomalies, and investors have arbitraged them away. They have traded and obtained abnormal returns from trading based on these anomalies, and slowly they vanished from existence because of this market action and market reaction to the knowledge regarding the anomalies. At least that's one of the possible explanations and one of the stories that exist. And that's all there is for now regarding Monday, Friday, and weekend effects. Please leave a like under this video if you found it helpful. In the comments below, I would be eager to see any suggestions on future videos on business, economics, or finance you would like to see on this channel. And please don't forget to subscribe. Thank you very much, and stay tuned.